All right, let's dive into something that's really changing the game for investors: fractional ownership. We're going to break down how you can own a piece of prime real estate even if you don't have millions sitting in the bank. So let's get right into it.
For so many of us, owning property is way more than just an investment, right? It's like the ultimate goal. It's about having a real, tangible asset, something you can literally point to on the skyline and say, hey, I own a part of that.
I mean, let's be real. Who hasn't walked by some shiny new office building and just wondered, man, what would it be like to own a piece of that?
Well, for the longest time, that's exactly what it was. Just a dream. This whole amazing asset class was pretty much locked up, only open to big institutions or people with tons and tons of cash. It was a very exclusive club. But here's the cool part. Thanks to new technology and some really smart financial setups, the doors to that exclusive club, they're finally starting to swing open for the rest of us. And the key that's unlocking those doors, it's a model called fractional ownership. So let's break down what that actually means and how it all works. At its heart, the idea is actually super simple. Instead of one person needing enough money to buy an entire building, a whole group of people, of investors, pool their money to buy it together. And then each person owns a fraction of it based on how much they put in. And here is the absolute best way to get your head around it. You know how you can go and buy a few shares of a huge company? Well, this is the exact same idea. But instead of an abstract piece of a corporation, your share represents direct ownership in a real, physical, brick-and-mortar building. Now, a lot of people immediately ask, wait, isn't this just like a REIT? And that's a really good question, but there is a massive difference. With a REIT, you're basically buying into a big bucket of properties that someone else manages. You don't get to pick and choose. With fractional ownership, you're in the driver's seat. You get to look at the options, do your homework, and pick the specific building you want to put your money into. So, besides having that control, what's the big appeal here for an everyday investor? I mean, what's really in it for you? Let's get into the main benefits.
First off, and this one is pretty stunning, is the entry point. You can get started with as little as 25,000 rupees. That huge wall of money that used to keep most of us out of premium real estate, yeah, it's pretty much been torn down. And it goes way beyond just the low entry cost. First, you've got passive income. Just think about it. Rental income hit in your bank account every month without you ever having to deal with a single tenant. Second, it's amazing for diversification. You can easily put a little money into an office building here and a retail space over there. And finally, you get professional management. A dedicated team handles the whole shebang, finding tenants, doing maintenance, all the paperwork. And hey, don't just take it from me. Experts in the field, like Mananki Parlulekar from Claravest Technologies, totally agree. She points out that this lets new investors start small and get into these professionally vetted deals that before were just completely out of reach. Okay, so the concept is exciting, the benefits are pretty clear, but you're probably wondering, how do I actually, do it? Let's walk through the actual steps to get started. It's actually a lot more straightforward than you might think. First step, you do a little research and pick a fractional ownership platform that feels right for you. Second, you do the standard one-time KYC verification online. That's the Know Your Customer process. Then, the fun part, you get to browse all the properties they have listed, look at the details, and invest in the one you like. And finally, you get all the legal paperwork for your share, and you start earning that rental income. And just to give you a head start on your research, some of the well-known platforms in India doing this kind of thing are names like Strata, Strata, HBits, and MY Rice Capital. Okay, before we get too carried away with all the potential upsides, it is absolutely time for a reality check. Because just like any investment out there, fractional ownership has its own set of risks and some really important questions you've got to ask. So yeah, let's just hit pause for a second here. Before you jump in, it is so important to understand the potential downsides and to go into this with your eyes wide open. The main risks to really be aware of are these three. First, there's liquidity risk. This isn't like stocks. You can't just sell your piece in a split second. It can take some time to find a buyer. Second is property-specific risk. What happens if the main tenant in your building decides to leave? Well, that could mess with your rental income. And finally, there's always market risk. If the whole real estate market takes a dip, the value of your piece of the property could go down with it.
This is probably the number one question that pops into everyone's head. Is this whole setup actually legit and legally sound here in India? And the short answer is yes. It's made possible through a specific legal setup. See, your money doesn't buy the property directly. It goes into something called a special purpose vehicle, or SPV. You can just think of the SPV as a little private company created for just one reason, to own that one specific building. So when you invest, you legally own shares in that company, and that's what gives you your stake in the property.
All right, the final big question. And of course, it's the one everyone wants to know. We've talked about the risks, but what about the rewards? What kind of returns can you actually realistically expect from this? Your returns here really come from two main places. The first is the rental yield. That's the income you get from tenants, and that usually lands somewhere between 8 and 10% a year. The second piece is capital appreciation. That's the profit you make if and when the property gets sold for more than you bought it for. When you put those together, the total expected return, or IRR, is often in that 14 to 18% range. So we've covered what it is, the good, the bad, and how it all works. And that just leaves us with one last thing to think about. With such a low barrier to entry and the real potential for passive income, could owning a small piece of a very big building be the next step for your financial future? Well, that's something for you to decide. Thanks for tuning in.